The S&P 500 technical trend and momentum remain bearish, but are nearing areas in price and time this week, which might produce a short-term low, allowing for the start of a sharp bounce into February. Given the orderly selling that has occurred this month versus the abrupt, unexpected decline in mid-December, it might be unlikely that capitulation measures happen right away before equities bottom. Given the return to stock-bond positive correlation, some evidence of yields peaking will likely be important to trust any bounce in the equity market. Stocks like Apple and Nvidia look to have arrived near important levels. And given the worsening in sentiment in recent weeks, a reversal to this recent downdraft looks quite likely this week, at a time when many investors least expect it. However, the extent of the breadth deterioration has proven severe in recent weeks, and a bounce in equal-weighted S&P 500 might be necessary before having too much confidence that a sustainable low is firmly in place. The following 10 technical catalysts are coming together to make a strong case for a low to this recent sell-off. S&P 500 is approaching last November's lows and Fibonacci-based price support. SPX is approaching intermediate-term uptrend line support from the October 2023 low. Both Apple and Nvidia are now within 1 to 2 days of bottoming out, technically as both near meaningful levels of support. Sentiment is turning bearish. Fear has begun to creep back into markets. DeMark-based exhaustion could be in place for SPY into Wednesday's CPI report TD buy setups. Elliott wave structure is also getting close to bottoming, given the shape and pattern of this decline since mid-December. The technology, financials, industrials, discretionary, and communication services sectors are all nearing intermediate-term trendline support on weekly charts. Market breadth gauges have reached abnormally low levels. S&P 500 percentage of stocks above their 50-day moving average DMA equals 16%, the lowest since October 2023. While percentage of S&P 500 issues above their 10-day DMA, which has begun to show positive divergence compared to mid-December 2024. Short-term cycle composites, based on emphasizing the 80-day cycle, show a bottoming in the S&P 500 potentially as early as this week, followed by a sharp bounce into mid-February. Treasury yield charts across the curve, 2, 5, 10, and 30-year yields, all look close to signaling exhaustion on this rally in yields, which could mark a peak in yields between January 15th and January 21st, before pullbacks over the next 3 to 5 weeks. Given the positive correlation between treasuries and equities lately, any hint of yields starting to peak out could likely be a positive catalyst for an equity rally. S&P 500 index. Breakdown in the S&P 500 has not affected the intermediate-term structure. While the extent of the recent equity market deterioration has proven severe on an equal-weighted basis since early December 2024, the intermediate-term S&P 500 has not shown a similar level of trend damage. Weekly charts show strong trendline support near 5,700, lining up with last November's lows, along with a meaningful level of Fibonacci-based retracement of the prior August-December advance. I am expecting that 5,700 holds for S&P 500 on this sell-off, and that lows should be near and potentially here by this week's CPI report. The alternative scenario would call for a short-term low by Wednesday, Friday of this week, a small bounce, and then a retest of lows, which doesn't make much downside progress and brings about a plethora of breadth and momentum-based divergences, bullish. Bottom line, a trading low looks to be right around the corner. S&P 500 index. Financial sector, along with many other major sector ETFs, is now reaching support. Simply stated, nearly half the S&P 500's major sectors are now nearing uptrend line support from lows established back in 2023. While many of these major sectors have underperformed sharply since last November, sectors like technology, financials, industrials, communication services, and consumer discretionary all look to be nearing important support after recent weakness. S&P 500 daily cycle composite seems to bottom in the next 2 to 5 trading days. When running the shorter-term cycle composite for S&P 500 with a starting point of 2016, the near-term cycle composite shows a pronounced low over the next 2 to 5 trading days and a turn-up into early to mid-February. This composite favors the 80-day trading day cycle, which has proven to be important over the last 9 years in pinpointing quite a few highs and lows for the S&P 500. This cycle idea is truly up to interpretation as it follows some very esoteric and storied pioneers. At the same time, if it works, hey, it works. I am bringing it up as the markets have seemed to respect it of late. If this relationship holds, then the cycle should bottom over the next week and rally into mid-February before weakening further into March. Given that the cryptocurrency cycle composite, as well as Treasury yields, both highlight March as having potential for an inflection point, I'm starting to give more credence to the idea of a bottom in many risk assets materializing in March before a sharp rally into the third quarter, the key to the next data point. Thus, while a short-term low looks to be approaching, it's going to be paramount for the S&P 500 to exhibit a broad-based rally over the next month to avoid many sectors bouncing only before turning back lower. S&P 500 daily cycle composites. As has been discussed in these reports over the last couple of months, market breadth has been lacking late. Thus, a stronger than normal recovery will be needed to have faith in the longevity of any bounce. If markets bottom and rally into February, but the rally appears thin and lacks ample participation, then the scenario laid forth earlier arguably becomes a strong possibility. I'll monitor this as markets start to stabilize and potentially bounce in the weeks ahead. In closing, the markets had a number of days at new highs in 2024. As a result, every time the markets hit new highs, new support lines and new extension targets are created. Once the high was hit in November and then the market digested the gains, a new question arises. Is this it and the party is over for a while, or is this simply another pause that refreshes? This is what I am attempting to quantify for you here in this note. The way we will know, I think, is how the market bounces, how high it bounces, and how many sectors and companies participate in the bounce. If breadth doesn't increase, and if the market can't get to or extend to another new and higher high, then it could mean that we need a longer period of time for the huge move from October of 2022 to digest. On these points, only time will tell. One last point to share is the economic impact of the floods from Hurricane Helene and the fires in Southern California. The effects on the economy to rebuild are substantial, and the length of time it will take to rebuild are also quite long. Here is a recent graphic I found giving some perspective. I don't mean to prey on adversity, but in adversity there can often also be opportunity presented. Our hearts go out to all those that have lost their homes, their family histories, and to some, the lives of loved ones. We also praise and thank all the first responders and all those that jump to the aid of those in need by contributing and helping at the recovery centers. My wife helped in transporting to the Santa Anita racetrack in Los Angeles. We were amazed at the selfless efforts of all involved and amazed by the sheer volume of aid contributed. As always, please contact us if we may be of assistance.